You've probably seen these candlestick patterns around and heard they're the best for trading. To some extent, this might be true. But what if I told you that the real power lies precisely in the most ignored patterns? That the weakest, most confusing, and non-standard patterns are actually the ones that work best? This might even confuse your thinking. There are various patterns that seem weak at first glance, like the spinning top, the doji, and even the umbrella. However, contrary to what many people think, these types of candles usually have an extremely high success rate. And the most curious thing? Almost nobody pays attention to them. The truth is that most people still rely on large candles, believing they represent strength and continuity. But that's fake. As you can see in this case, a big drop was generated after a sequence of big candles. In practice, the more subtle patterns, those that almost nobody values, tend to be much more efficient at identifying profitable opportunities. You've probably always heard that patterns like the hammer, inverted hammer, tweezer bottom, or evening star are the major signals you should look for on the chart. And to be fair, they do work in many contexts. But what few people realize is that patterns considered weak, when interpreted in the right context, reveal even more powerful information. Because when you understand the logic behind candle formation, you realize that the market rarely delivers obvious signals. And moreover, when it seems too easy, it's a sign that the entry point has already passed. To show you this clearly, I've organized solid concepts from experts like Al Brooks and adapted everything with real examples, straight from the chart. Large candles typically represent indecision in the market, not strength. This is because when a candle is very extensive, it breaks through multiple price levels in a short period of time. And this creates instability. Think of it this way: it crosses several support or resistance levels quickly. This means that all sellers at these broken levels will start to pressure the market downward simultaneously. At the same time, buyers will need to work even harder to break higher prices. That's why these large candles frequently fail during trends, breakouts, or even channels. It's a pattern you can observe daily in the market. And this is where small or non-standard candles come in. A candle like a doji is normally seen as indecision. But, in my view, it's a great continuation signal in a trend, for example, precisely because it's a hidden pullback. It offers entry opportunities. Experienced traders identify dojis in trends as possible entry points with reduced risk, similar to how they would use conventional pullbacks. Practical example: in the S&P 500 index, during a clear uptrend, observe when a doji appears after 4 to 5 consecutive up candles. Instead of interpreting it as indecision, place a buy order just above the doji's high, with a stop loss below the low. This strategy has shown a success rate of approximately 70% in strong trends. Let's look at some candle patterns you should look for in trends. One pattern is the gravestone doji, which has a long upper shadow and no lower body. It shows that buyers tried to push the price up, but were completely rejected, a clear signal of a short pullback in the trend. The same applies to the inside bar with a small body, which emerges when an entire candle is contained within the range of the previous candle. This compression shows that the price is trapped. And these are excellent opportunities for entering a profitable trade. Also important to pay attention to Haramis at the top of a trend. This pattern forms when a small candle appears within the body of a previous larger candle, indicating that the movement has lost strength and continuity is in doubt. An even more significant detail is when a doji appears with an upward gap, meaning the market opens above the previous close, but fails to advance. This behavior shows that, even with excitement at the opening, buying strength may need a breather. Another classic rejection signal appears when the market forms candles with long upper shadows and small bodies, also called inverted pin bars. This reveals a frustrated attempt at an upward move, with strong selling pressure entering. And when we see several small candles in a row at the top, we're looking at a micro-congestion, which can signal another opportunity. We've talked about trends, but what about channels? Well, let's see what Al Brooks tells us about this. In the middle of a channel, for example, a doji usually has little value. It's just a pause in the movement, a zone of equilibrium where the market naturally oscillates between buying and selling. Here, Brooks generally ignores this type of candle, since there's no clear strength or defined intention from participants. Unless this doji comes as part of a larger pattern, like a flag or a breakout failure, it goes unnoticed. But when the doji appears at the extremes of the channel, the interpretation changes completely. Imagine an upward channel. If the price slightly breaks the upper edge of the channel and then prints a doji, this signal can represent exhaustion of buyers. And if the following bar is down with a strong body, we have an indication that the market is rejecting the breakout. Here, Brooks begins to consider a contrary entry, expecting a correction or even a reversal. On the other side, if the price is falling to the lower edge of an upward channel and forms a doji there, followed by a strong upward bar, this indicates defense by buyers. In other words, the market is reacting at the trend line, and this formation can be a good opportunity to enter in favor of the main trend. In very narrow channels, with several small bars and full of dojis, Brooks calls this a micro-channel. Even though it seems weak, this type of movement is still a valid trend. He avoids trading against these micro-channels until a strong bar appears in the opposite direction that breaks the pattern. And when the price breaks a channel, and soon after prints a doji, this is a classic signal of a possible false breakout. The doji shows that the market is undecided or uninterested in that breakout. If the following bar confirms weakness, the price is likely to return inside the channel. In the end, the doji, by itself, doesn't say much. But positioned in the right place and read along with market behavior, it can reveal hidden intentions. Al Brooks teaches that the secret isn't in the candle itself, but in the context where it appears. And that's what separates an average trader from someone who truly understands the psychology behind the chart. These patterns, although subtle, carry valuable information about market dynamics and are powerful tools in the hands of traders who know how to read beyond the appearance of candles. Instead of merely seeking visible strength, observing moments of indecision can be the key to anticipating major movements with precision.